conversation with Anil Agarwal, who's the head of banking at Morgan Stanley. Lata, over to you.
Thanks a lot. Yes, and he's the man of the moment because, as you know, yesterday the Nifty rally itself was led largely by the PSU Bank Index, up 4.5%. Even the Bank Nifty was up nearly 3%. And throughout this rally, the banks have shouldered a better part of the rise of the Nifty. So, Anil Agarwal, thank you very much for joining us and taking time before you run to your conference. Well, first up, what are you going to tell your conference delegates? Is there more juice left in the Bank Nifty, in the Bank Index?
So the way Lata, first of all, thanks for inviting me for this show. The way I'm looking at Indian banks right now is that in the last 2 or 3 years, Indian banks were facing problems from an NPL formation perspective. Yeah. But now I think NPL formation is behind us in the sense that in the last 3 years, Indian banks have reported $100 billion or more than $100 billion of new bad loans. That's almost 20% of all loans that were given in the last 5 years. So I think India is the only market where we are getting out of an NPL cycle. So in that sense, I think there's still a bit of normalization trade left. The second part of the rally could come if reforms actually cause economic growth to pick up, which will mean that we can start seeing rebasing of revenue expectations upwards. And that can cause a meaningful rally from here also. So that's a message that I'm giving, that look out for loan growth pickup, if at all.
Actually, that argument gives me the sense that you should be liking public sector banks, but I'll come to that in a bit. First, the private sector banks. It took our breath away the way Yes Bank and Kotak Bank raised 5,000 crores in a single day, with their share prices actually rising after the issuance or after the share sale. Do you think there's more juice left in private sector banks? What's your pecking order?
No, absolutely. So if you look at the private sector banks right now, most of these stocks are still trading at less than average multiples globally. Less than average multiples if I look at it from a 10-year perspective. So again, and what is happening with the investors, I was in US last week meeting investors. I think investors are looking at India and they're saying that, you know what, we can be at the beginning of a 5-year growth cycle here. So if investors think that we can have loan growth for private sector banks running at 20% or higher compounding for the next 5 years, I think for the private sector banks, the juice can be quite meaningful because they will also gain share from the public sector banks, which are facing problems from a capitalization perspective. So I think private banks, even from these levels, can give you a very meaningful upside. I mean, you need to hold it for 3 to 4 years, but the upside can be meaningful. And we have a buy on or overweight on every single private sector bank that we cover right now.
Yes, I saw that in your list. Axis, HDFC Bank, ICICI Bank, Kotak Bank, HDFC, yes, IndusInd and ING are all overweight.
All overweight.
Okay, what about public sector banks? I see them as equal weight, which means you're neutral. If you believe in this NPL cycle as having peaked out, should you not be buying them?
So there are two parts of the NPL cycle, Lata. The first is bad loan formation, which I think has peaked. So from June quarter onwards, you'll start seeing a meaningful decline in bad loan formation. But the second thing is actual credit costs being taken. And I don't think the state-owned banks have actually taken credit costs. So if you look at the coverage ratios, including restructured loans, the coverage ratios for various banks range from 20 to 30%. So even if bad loans keep declining, they will have to take credit costs, which means that earnings progression will be very tough. Second thing is they need capital. So whichever way we look at it, state-owned banks need about $30 to $50 billion of capital. So if you build that in, ROEs for the state-owned banks for the next 4 or 5 years, I think will struggle to be in teens, forget about higher than that. So right now what's happening is that there's a normalization trade going on. So market is saying, okay, India is not bad, it's good. So anything which was priced for weak macro is basically coming to average levels. But from now on, if growth is to come back, I think I would suggest to investors that you own stocks which will actually participate in the growth rather than just a normalization. That's private banks.
How much is this normalization trade still to go? I mean, I know at some points in time the BOIs and even union banks were trading even below half times book. I mean, 0.3 was the order of the day. Now I think they've moved to what, 0.7? So is it one-time book that you would call normal?
I don't know whether it's one time or 0.7, 0.8. My view is it's almost over. Because again, if I won't go into specific names, but say if a bank is giving you 11 or 12% ROE, sustained ROE in a country where cost of equity is 14 to 15%, paying one-time book is not normalized valuation. It's much higher than normalized valuation. I think normalization trade is broadly behind us.
Okay, let me quickly get this argument in. Yesterday, CNBC TV18 reporter said that you know, the government is contemplating putting all its shares in government banks into that bank investment company. Now, this smelt like the first reform of public sector banks. Would you not want to buy ahead of that, or you will want to wait to see it happen?
Again, going back to the point that I was making on capital, so for PSU banks, depending on the economic recovery, need about $30 to $50 billion of capital, and I don't think a lot of that capital will come from private players. It has to be a government solution for large parts of that capital. So we need to wait and see what the bank holding company looks like and what the structure will be like. But I think this is just a way of recapitalizing these banks. So as I said, it's a good thing because it reduces the tail risk from the economy, because if PSU banks can't lend, I mean, economy will not grow. But would I want to buy a sector which is going to give me, after building the capital issuance, which is going to give me barely double-digit ROE on a sustained basis? Not really. Maybe there's a bit more of normalization trade left, but I think we are close to the end.
Tactical trade left, perhaps.
Yeah, which are not
beta trade.
Yeah.
Okay, let me come to the NBFC sector then. Are you very hopeful of that sector? You like anybody there, or have they also risen enough?
No, I think even the NBFCs, if you look at it, so they have two things going for them, assuming that reforms do come through and economic growth does pick up. There are two things going for them. One is that most of these NBFCs have been facing perennially high funding costs for the last 2 or 3 years. So as we move ahead, if inflation starts coming under control, the funding costs will come down. At the same time, I think there's a pricing advantage that these NBFCs have, given the whole base rate phenomena in India. So you potentially have margin expansion story in NBFCs for the next, again, 3 to 4 years. On top of that, all these guys have, all these NBFCs have generally done very well despite what was a very weak economy for the last 3 years. So I think if you look at the balance sheet now, they have gone through a pretty bad cycle. They have very strong capital base. I think they'll start reporting reasonably strong loan growth and margins expanding, so you want to own the NBFCs too. So again, any private lender I would want to own, because I think it's going to be a market share game going ahead.
I don't know if you're allowed to name names, but I really wish you would. Which are the banks where you are now uncomfortable in valuations? I mean, it's almost hitting a peak types. And where do you think the economic situation is such that you are on the cusp of an upgrade?
Second question, I definitely can't answer on the cusp of an upgrade. And the first question, actually, if you look at the valuations, most of the banks right now are trading at average or lower than average multiples. Okay. So I mean, even the most expensive names that we can think of, they're also trading at well below long-term average.
Even HDFC Bank is
look at their average they're trading at well below average multiples compared to their long-term history. So unless economy disappoints, I think there's much more to go in the banking sector rally.
And therefore the Bank Nifty may continue to shoulder a bulk of the rally of the Nifty?
Absolutely.
All right. On that positive note, Anil Agarwal, pleasure speaking with you.
Thank you so much.
Well, you heard that. Gokul was very positive, and so is his banking analyst, Anil Agarwal. Back to you.
As the Sensex surges to record highs, investors expect the new government to fast-track reforms and accelerate economic activity. Morgan Stanley presents the 16th Annual India Summit, bringing together leading institutional investors